How much does a fractional CFO cost per month? The pricing model answers most of it. A fixed monthly retainer against a defined scope with no hourly billing. Strategic financial leadership without the full-time hire. That's the promise, and the retainer is how it's priced. Coming up, the 3 tiers, what sets them apart, and what the retainer deliberately excludes. Here are the numbers. Engagements run as 3 tiers on a fixed monthly retainer. Strategic, $3,000 to $5,000 a month. Active, $5,000 to $7,000. Intensive, $7,000 to $8,000 and up. Every tier is quoted against a written scope before the engagement starts, and no tier, at any intensity, is billed by the hour. What moves a business from $3,000 a month to $8,000 is not negotiation, it's definition. The tiers are set by 3 things: operating rhythm, monthly versus weekly, deliverables, and intensity. When an event-driven window opens, a fundraise and M&A process, scope and retainer flex with it. What you're paying for at each level is defined before you pay it. Inside every tier, the retainer buys work across 6 defined areas: financial strategy, cash flow and forecasting, board and investor reporting, fundraising and capital, KPI and unit economics, and senior advisory, including M&A. What we cover and what we don't is drawn explicitly, so the monthly retainer maps to a scope you can point at. Behind the pricing sits the reason the model exists. A fractional CFO is an experienced finance executive serving as a part-time chief financial officer, strategy, forecasting, board work, fundraising, and the senior decisions in between on a fixed retainer. Businesses between $1 million and $50 million in revenue need that work, but can't justify a full-time hire at that level. The economics of CFO work at this stage are the whole argument for paying monthly instead of paying a salary. Part of what keeps the retainer honest is what it will never include. A fractional CFO is not tax filing, not audit, not legal. Those stay with the licensed professionals the CFO coordinates with. And a fractional CFO does not replace your CPA. Your CPA or EA keeps income tax filing, tax positions, and IRS representation, while the CFO runs operational and strategic finance and coordinates with them, without filing taxes and without giving tax advice. Before comparing retainers anywhere, make sure you're pricing the right role. A controller manages accounting operations, the close, the statements, the controls. A fractional CFO operates strategically, planning, forecasting, fundraising, the board. Growth stage businesses often need both, and the split is clean. The controller produces the continuous output, and the CFO interprets it and drives strategy. Pricing a controller when you need a CFO answers the wrong question. When is the retainer worth paying at all? 3 inflection points. Revenue crosses the first few million and decisions get materially harder. A capital event is ahead, fundraising, refinancing, or a sale, or scaling complexity has outpaced the finance function you have. The signals are concrete. You're preparing to raise, you're running blind on cash flow, your board wants better reporting, an exit is in view, or your CEO is personally doing CFO work. Month to month, the retainer buys a defined rhythm, not ad hoc calls. An operating rhythm sets the recurring cadence, weekly, monthly, and quarterly, each carrying their own obligations. A close and board reporting cycle runs every period. A strategic review steps back from the numbers on purpose. And capital and transactions work engages when there's an event to run. Which of those apply to you and how often is exactly what your tier decides. Certain profiles get full value from this pricing, and the honesty runs both ways. It works for bootstrap growth stage operators, venture-backed companies between rounds, PE portfolio companies, pre-exit owners, and multi-entity or multi-state operators. And there are businesses fractional CFO is wrong for, where the honest answer is that the model doesn't fit, and a retainer shouldn't start at all. Underneath every tier sits one prerequisite. CFO work only delivers value on accurate books. Do you need clean books before a CFO engagement? Yes, and if the file isn't there yet, the bookkeeping can be run underneath the engagement so the CFO is working from numbers that hold. Fractional CFO work connects to the services around it for exactly that reason: cash flow management, performance review, and the monthly bookkeeping underneath it all. One more thing the retainer buys that's easy to miss: a senior operator named accountable, and the actual CFO who shows up to your board meeting, rather than briefing someone else to attend it. If those numbers match your stage, the path is deliberate. An application, a diagnostic call, a written scope and match, then the engagement start. Engagements are accepted by application and limited per quarter to preserve senior attention. Strategic finance without the full-time hire. One call tells you exactly where your books stand. Send this to whoever shares the finance decision with you, and subscribe for the rest of the advisory series.